Hey everyone, welcome back to Gold Rush Reporter, where we dig deep into the real forces driving the gold and silver markets. I'm your host and analyst, and today we're talking about something truly exciting. The stage being set for what could be the next major upleg in the silver bull market. After years of sideways action and false starts, silver might finally be ready for a historic breakout. And I'm going to explain exactly why this moment matters. For nearly 50 years, silver has been forming what's known in technical analysis as a cup and handle formation. It's one of the most reliable bullish patterns in market history. And now, silver has finally broken above that long-term resistance line. That's not a small deal. This is a multi-decade setup that's now flashing green for long-term investors. On Friday, we saw a very important technical confirmation. Silver retested that breakout level and closed above it. In simple terms, that means the breakout is real, not just a short-lived spike. Think of it this way. When a market breaks through a ceiling that has held it down for decades, that ceiling usually becomes the new floor. This shift from resistance to support is what gives professional traders confidence that a new bull phase has begun. And that's exactly what we're seeing with silver right now. On the long-term chart, this breakout level had capped prices for more than 10 years. But now, it's acting as solid support. That's the market saying, I'm ready to go higher. This is what we call classic technical behavior. Breakout, retest, and validation. When you zoom into the daily chart, the story becomes even clearer. After several strong weeks of upward momentum, silver pulled back slightly, testing investor patience. But that pullback didn't signal weakness. Instead, it was a healthy correction, a chance for the market to catch its breath. Buyers stepped in exactly where they were supposed to, right around the previous resistance level. That's a textbook signal that momentum is still strong. Another positive indicator comes from silver's RSI, the Relative Strength Index. The RSI has cooled down below 70, which is ideal before the next leg higher. When RSI stays overbought for too long, the market tends to correct. This small reset helps silver regain strength before another move upward. And even on the 1-hour chart, silver has tested that breakout line twice, with buyers defending it both times. Each successful test adds more credibility to the breakout. But it's not just about charts. Behind these technicals lies a much bigger story, the macro environment. Silver isn't moving in isolation. The global economy is changing in ways that directly favor precious metals. The Federal Reserve recently hinted that quantitative tightening, their program to shrink the money supply, might soon come to an end. Chair Jerome Powell cited a cooling labor market and balanced risks as reasons for slowing down policy tightening. That's code for we're preparing to ease again. Historically, that kind of pivot has been rocket fuel for gold and silver. Every time the Fed ends a tightening cycle, liquidity starts flowing again. Inflation expectations rise, and investors rush toward real assets, especially metals that can't be printed. So what we're seeing is the perfect combination. Technical confirmation from the charts and sharp fundamental support from central bank policy. To add to that, stress is already showing in the financial system. Regional bank stocks are falling again, reminding everyone of the 2023 banking crisis that forced the Fed to quietly expand its balance sheet. If credit stress worsens, the Fed may have no choice but to step back in with another liquidity program, which would effectively mean another round of money printing, even if they call it something else. And as we've seen time and time again, when the Fed prints, gold and silver rise. So to sum up this first part, silver has just confirmed a massive technical breakout, its RSI has reset to healthy levels, and global monetary policy looks ready to shift toward easing again. These are exactly the conditions that often mark the beginning of a major bull run, not the end. If you've been waiting for confirmation before getting serious about silver, this setup might be the one that long-term investors dream about. Stay tuned, because in the next part, we'll go deeper into what's happening behind the scenes, from central bank demand to real-world shortages, and why this breakout might be far bigger than it looks on the chart. Silver's breakout isn't just about technical charts or market psychology. It's being reinforced by a major shift in the past real-world fundamentals that drive the supply and demand balance. We're seeing clear evidence that physical silver is becoming harder to find, even as investor interest continues to rise. Bloomberg recently reported that the Royal Mint in London is struggling to meet surging demand for silver coins and bars. Delivery times are stretching longer than usual, and in some cases, the Mint has even had to import silver from New York to fill European orders. That's a remarkable situation, one that highlights just how tight the physical market has become. At the same time, bullion dealers across London's Hatton Garden district have described this as a perfect storm. Buyers are queuing outside of shops, waiting to grab any available metal, while the Royal Mint runs its presses around the clock. Prices in London are up more than 80% year to date, yet the demand hasn't slowed. Normally, when prices rise sharply, retail investors back off, expecting a pullback. But this time, we're seeing something different. Panic buying. People aren't buying silver for short-term profit. They're buying it as protection against economic instability. This shift in psychology is critical because it tells us the move is driven by fear and preservation, not speculation. In the institutional market, the same stress is visible. The 1-month lease rate for silver fee in London, basically the cost of borrowing the metal, has skyrocketed to an annualized rate of around 35%. That's higher than even the levels seen during the Hunt brothers' silver squeeze in 1980. When lease rates surge like this, it's a clear signal that there's a serious shortage of available physical silver. Most of the existing supply is either held in ETFs or stored long-term by investors, meaning there's not enough to satisfy short-term demand. In other words, the paper market is running out of metal. This mismatch between the physical and paper markets has major implications. For years, large institutions have used paper contracts to suppress price volatility in silver. But when the physical market tightens this much, those paper games can't hold forever. At some point, reality forces a revaluation, and that's when prices can move fast. We may be approaching that moment now. It's not about hype, it's simple economics. Low supply plus rising demand equals higher prices. Meanwhile, macro conditions continue to provide strong tailwinds. The US national debt is soaring past $38 trillion, and interest payments alone are ballooning to unsustainable levels. As debt compounds, confidence in fiat currency systems weakens, pushing investors to seek hard assets like gold and silver. Every dollar printed to cover deficits effectively makes each existing dollar worth less. This is the silent engine of the silver bull market, currency debasement on a global scale. Even central banks are quietly acting on this reality. Over the past year, they've been buying gold at record levels, and while silver purchases are less visible, the same motivations apply. Central banks can print money, but they can't print metal. That's why their accumulation of precious reserves often signals the early stages of a monetary shift. When the biggest players in the system start hedging against their own currencies, that's a powerful message. From a broader perspective, the gold to silver ratio still sits around 80, an unusually high level. Historically, that ratio narrows significantly during precious metal bull runs. In 2011, for example, it fell to the low 30s, which meant silver outperformed gold by a huge margin. If history rhymes, we could see silver dramatically outpace gold once again as this cycle unfolds. And given how far the ratio has to fall, that suggests we might just be in the such early innings of a much larger move. So, to put it simply, technicals show strength, fundamentals show scarcity, and macro conditions point toward continued monetary debasement. Every signal is aligning. The silver market isn't topping out, it's winding up. The next stage of this breakout could be even more powerful than the first, especially once institutional money starts recognizing what retail buyers already see. In the next part, we'll dive deeper into the investor behavior behind this rally, look at the miners that tend to outperform in these phases, and explore how smart investors are positioning themselves right now for maximum upside. As silver continues to attract attention, investor behavior is starting to reveal a fascinating pattern. We're witnessing a clear divide between short-term traders, looking to capitalize on quick moves, and long-term accumulators, who view this as a generational opportunity. This difference in mindset often defines how powerful a bull run can become. And right now, it's the long-term holders who are in control. Retail investors are stacking physical silver like never before. The trend isn't just visible in Western markets, it's global. From Germany to India, people are lining up for bullion, coins, and even old silver jewelry. Anything that gives them real metal in hand. Dealers report record premiums, and in some cases delays of weeks before they can fulfill new orders. These are the same signs we saw during the early stages of previous bull markets. When physical silver becomes scarce and buyers are willing to pay far above spot, it's a powerful signal that confidence in paper money is eroding. Institutional players, who often move more quietly, are starting to show interest too. Hedge funds have begun increasing their exposure to silver futures and mining stocks, but what's interesting is the way they're positioning cautiously at first, then scaling in on every dip. That's the behavior of smart money recognizing value. Historically, when both retail and institutional demand align like this, it leads to sustained price strength rather than a temporary rally. At the same time, miners are beginning to show leverage to the upside. Silver mining companies typically move 2 to 3 times faster than the metal itself when prices start trending higher. We are already seeing that pattern unfold. Several mid-tier producers have posted their best quarterly results in years, not just from rising prices, but from disciplined cost control and improved efficiency. Many of these companies were forced to streamline operations during the tough years when silver stayed below $25, and now that prices are higher, those leaner structures mean fatter profit margins. This leverage effect is what makes miners so compelling during a bull phase. For instance, if silver rises 20%, a miner's profit can increase by 50-100%, depending on its cost structure. That's why sophisticated investors often use miners as a way to amplify gains during a precious metals rally. But here's the catch. Timing matters. You don't want to buy miners after they've already exploded in price. The best time is during the early to mid stages of a breakout, when sentiment is still skeptical but fundamentals are improving. That's the window we seem to be in right now. Another point to consider is how exchange-traded funds, ETFs, are responding. Silver ETFs have begun seeing steady inflows again after months of outflows. This shift shows that mainstream investors, the ones who prefer convenient exposure over physical holding, are starting to re-enter the market. Typically, ETF inflows lag the physical buying trend by a few weeks or months, but once they start, they can drive additional demand pressure because these funds must hold actual silver to back their shares. That can tighten the supply even more, creating a feedback loop that pushes prices higher. Meanwhile, the narrative around silver is evolving beyond just a precious metal. More analysts are recognizing silver's industrial role in the clean energy transition, especially in solar panels, electric vehicles, and advanced electronics. Each of these sectors is projected to grow significantly over the next decade, meaning industrial demand will continue to rise even if investment demand slows temporarily. This dual nature, both industrial and monetary, is what makes silver unique among metals. It's both a commodity and a currency hedge at the same time. The deeper we go into this trend, the more it resembles a textbook early bull market setup. The physical market is tight. Investor sentiment is turning positive. Miners are gaining momentum. And institutional money is quietly positioning itself. This combination doesn't happen often, and when it does, it usually precedes an explosive move upward. In the next part, we'll explore the geopolitical forces adding fuel to this rally, from the de-dollarization trend to global trade realignments, and how those macro shifts could redefine silver's role in the global financial system. The surge in silver isn't just a reflection of market trends or investor psychology. It's also tied deeply to the shifting geopolitical landscape. Around the world, we're witnessing a slow but undeniable move away from the US dollar as the dominant reserve currency. This process, often called de-dollarization, is one of the biggest structural changes in global finance since the 1970s. And believe it or not, it's directly influencing the demand for precious metals, especially silver. Over the past few years, several nations have been quietly accumulating gold and silver as part of their strategy to reduce dependency on the US financial system. Countries like China, Russia, and India have increased their precious metal reserves, while even smaller economies are exploring trade settlements in local currencies. These moves might seem gradual, but collectively, they're reshaping how global trade operates. When countries start preferring hard assets over paper promises, metals like silver become strategic assets, not just commodities. Variant, Standard, ID 10836, Title, Gold Rush Reporter, Central Bank Moves and Investor Strategy, Part 5. Central banks play a much bigger role in shaping the silver market than most people realize. While they don't directly hold large silver reserves like they do with gold, their monetary policies indirectly drive silver's value. Every decision made by the Federal Reserve, the European Central Bank, or the Bank of Japan, whether it's about interest rates, balance sheet expansion, or currency interventions, influences how investors view real assets. When central banks pivot toward easing, it typically means one thing: more liquidity in the system. And history shows that whenever liquidity increases, the prices of real, tangible assets, like gold, silver, and commodities, surge. Investors start to fear that cash is losing purchasing power, so they rush into assets that can't be printed or devalued overnight. Silver, because of its smaller market size and dual industrial monetary nature, often reacts more dramatically than gold during such transitions. Right now, all the signs point toward another global pivot. Inflation may have cooled slightly, but debt levels are at record highs. Governments cannot sustain high interest rates for long without risking economic collapse. Sooner or later, they will have to inflate away the debt, which means printing more money or initiating new stimulus programs. Both outcomes favor silver. We saw similar patterns in 2008 and 2020. After massive liquidity injections, silver prices exploded upward within months. But it's not just about macroeconomics anymore. The global financial architecture itself is showing signs of stress. The US government's debt has crossed unprecedented levels, and interest payments alone are becoming unsustainable. At the same time, emerging markets are creating their own alternative settlement systems, bypassing the SWIFT network and experimenting with gold and commodity-backed trade mechanisms. This trend slowly undermines confidence in fiat systems and strengthens the case for metals as trust anchors. In such an environment, even retail investors are waking up. We're seeing a grassroots level response. Ordinary people buying physical silver, storing it privately, or pooling funds through online bullion programs. These small actions, multiplied millions of times, create real demand pressure in the market. It's no longer a niche hobby. It's becoming a silent global movement toward tangible wealth. For professional investors, the conversation is shifting from if silver will rise to how high it can go. Some analysts are targeting $50 an ounce within the next major cycle, while others see potential for three-digit prices if currency debasement accelerates. That might sound extreme, but remember, silver traded at $50 in 1980 and again in 2011. Adjusted for inflation, that level today would be closer to $120. In real terms, silver is still undervalued by decades of monetary distortion. Meanwhile, the miners, especially small cap and mid-tier producers, could become the real beneficiaries of this setup. Companies with proven resources, low extraction costs, and operations in safe jurisdictions could outperform dramatically. This is where investors who understand the fundamentals can find leverage without speculation. When silver prices rise, even modestly, miner profits can multiply due to fixed cost structures. That's why analysts often call mining stocks silver on steroids. We're also seeing growing interest from technology and renewable energy sectors. Large industrial buyers are starting to lock in long-term supply contracts, anticipating shortages. This move puts additional pressure on the spot market, making it harder for financial traders to keep prices artificially suppressed. The physical market is asserting itself, and when that happens, paper contracts eventually have to catch up. Another interesting shift is the rise of our sovereign wealth funds. Exploring precious metals diversification. Traditionally focused on bonds and equities, some of these massive funds are now studying opportunities in silver-related ETFs and industrial silver ventures. Even a small allocation from these trillion-dollar funds could have a major price impact because the silver market is so tiny in comparison. In essence, we are entering a phase where both macroeconomic forces and institutional behavior are aligning in silver's favor. The next revaluation might not come with fireworks at first. It could be gradual, steady, and relentless. But make no mistake, when confidence in fiat weakens and hard assets rise, silver's potential becomes undeniable. Variant, Standard, ID, Tondaus 837. Title, Gold Rush Reporter, Final Analysis and Channel Outro. When you connect all the dots, the technical breakout, the macroeconomic backdrop, the rising physical demand, and the geopolitical transformation, the conclusion becomes clear. Silver is not just in another rally, it's at the beginning of a generational shift. Everything we're witnessing right now points toward a revaluation of what real value means in a world drowning in paper money and digital debt. Think about it. Silver has broken out from a 40-year pattern, confirmed by multiple retests. The technical side says momentum is building. Meanwhile, the Fed and other central banks are inching closer to another round of liquidity expansion, signaling that monetary tightening is unsustainable. On top of that, retail investors are buying physical metal faster than refiners can supply it. And sovereign entities are quietly building reserves. This is not random noise. It's a coordinated evolution of capital toward hard assets. We've also seen how industrial demand is locking in the long-term picture. With the green energy transition accelerating, silver's role as a conductor in solar panels, electric vehicles, and battery technologies has made it essential to the modern economy. Unlike other metals that can be easily substituted, silver has no equal when it comes to conductivity and versatility. This means demand won't just rise, it will stay elevated for decades. Combine that with tightening supply, and the equation for higher prices becomes almost unavoidable. The emotional side of the market, investor psychology, also plays a critical role here. Historically, silver bull runs are born in frustration, grow through disbelief, and peak in euphoria. Right now, we're somewhere between the first two stages. Many mainstream analysts still ignore silver or call it volatile and unpredictable. But that's exactly what early stages of a bull market look like. Undervalued and underappreciated. The smartest investors accumulate quietly when everyone else is distracted. In the coming months, we may experience sharp pullbacks, fear-driven sell-offs, and plenty of fake news stories claiming the rally is over. But those dips often serve as fuel for the next surge. The key for long-term investors is discipline, understanding that silver's true value is not measured in weeks or quarters, but in the cycles and decades. The technical, fundamental, and structural setups we've discussed all align to suggest that the best is yet to come. As a gold and silver analyst, I see the next few years as the most exciting period for precious metal investors since the early 2000s. The opportunity here isn't just to profit, it's to protect purchasing power. In an age where currencies are being devalued faster than ever. For investors who stay informed, patient, and grounded, this could be a once-in-a-lifetime chance to ride a historic uptrend from its early stages. So, if you've been following this breakdown, make sure to revisit the charts, track the macro indicators, and keep an eye on physical inventory reports. The story of silver is far from over. It's just getting started. And remember, we're not chasing hype here. We're following data, fundamentals, and decades of market behavior that point to a powerful conclusion. That wraps up today's deep dive. If you found value in this analysis, don't forget to like this video, share it with other investors, and subscribe to the channel, so you don't miss our next update. Turn on the bell icon for alerts, because in markets like these, timing and knowledge are everything. This is Gold Rush Reporter, your trusted source for gold and silver market intelligence. Stay informed, stay patient, and as always, stack smart, not emotional. Until next time, I'm signing off. Gold Rush Reporter, uncovering truth, tracking value, and reporting the rush.